Hi, my name's Mark Pearce from iPlus, and this is just a brief overview of a balance sheet, which is going to zip through one. So we start at the top with fixed assets. Fixed assets are physical items that your company owns. So these are things like vehicles, buildings, computer equipment, anything that your company is physically purchased and owns. So it's part of the makeup of your company. Offset against this is wear and tear or depreciation. So in this example, we've bought a vehicle for £10,000, and over a period of time, we've depreciated it by 7,000 to give it a rough true market value of what you could get if you sold it of £3,000. The same with computer equipment. There's £1,250 we think we should be able to get for it, and £750 for the data store. So if you add all of these together, you get £5,000, and that's the fixed assets, which are physical items your company owns. We then move down to current assets. So these are cash, savings, what you're owed by your customers, items you have in stock ready for sale. These are all things that you can quickly and easily liquidate and turn into money. So from here you can see we have £25,000. Okay, so the other side is what you owe to people. So firstly, we've got the quick things that you owe. This is normally within a year. So these are the suppliers, people you owe money to. You have a £5,000 director's loan. So one of the directors has put money in to help the company, and that's owed. There's £2,500 worth of outstanding tax for your employees, and £5,000 accrued, which we need to pay HMRC. So these total £13,500. You then have long-term liabilities. These are normally items that you owe that are more than a year. So in this example, we have £8,000 still left to pay on a bank loan. So what we do is we add the 5,000 and the 25,000, and you minus the 13,500 and the 8,000, and you get to this figure, which is, if you sold everything up at the end of next month and nothing else happened after today, this is what you should be left up with. And this is how that 8.5 is made. So 500 of it was for shares bought in the first place. £6,500 worth of it is coming from current profit for this year, and 1,500 was from the previous year. So this then adds up to 8,500, and this balances with the net assets. If you need more information, there is the full book available by downloading it from the website, and or you can give us a call and we can go through anything that you need. Many thanks, and thanks for listening.